Bitcoin is a bigger change than most people realize. They often think it's just another monetary technology that kind of goes on top of our other monetary technologies. Whereas one thing I've been trying to emphasize is that
Hey guys, welcome back to Everyday Finance. In this video, Lyn Alden discusses Bitcoin and crypto. One important point to make is that Bitcoin represents a larger change than most people realize, that they frequently mistake it for yet another financial technology that kind of sits on top of our other financial technologies. However, Lyn has been attempting to emphasize that it is a departure from how cash has been working for like 100 years and a half. And he feels that is where you understand it's not. It's anything but a multi-decade reception story. It's a multi-decade monstrous pattern change in how cash functions, and lots of things Lyn Alden discusses. So please watch the video to end. And share this video and subscribe our channel, Everyday Finance. Thanks.
Yeah, the longer it goes, the bigger it gets. Some of the tail risks slowly start to be removed from the asset. It's challenging to talk about allocation because you have to separate how much you put into the network versus how much your allocation grew because the investment did well, right? So my allocation obviously grew quite a bit, but that's mostly from not selling my allocation and continuing to dollar cost average in. I think, one thing to emphasize is that Bitcoin is a bigger change than most people realize. They often think it's just another monetary technology that kind of goes on top of our other monetary technologies. Whereas one thing I've been trying to emphasize is that it is a pivot from how money has been working for like a century and a half. And I think that's where you realize it's not a one-decade adoption story. It's a multi-decade massive trend change in how money works. And what I mean by that is, I kind of separate money into three eras. The first era was pre-telegraph, right? So, and I focused a lot of this in my book, Broken Money, but to kind of summarize it, pre-telegraph, you had transactions and settlements moving at roughly the same speed, which is the speed of matter. You couldn't send information long distances quickly. And so the role of middlemen was, useful, like things like basic banking services on top of on top of gold, basic money transmission services on top of gold. These things were relevant, but this was a world where middlemen were relatively thin because of that transaction layer and the settlement layer having roughly the same speed. But then we entered a world ever since the telegraph and extending through today, where information can now flow around the world quickly, but settlement still cannot. And settlement basically means giving someone value that can't be reversed. Right? And so, other than physical gold and things like physical transfer, there's not really been a way to do settlement of monetary value. And so what that meant is that for like 150 years, since the telegraph became widely adopted, it's only made middlemen get bigger and bigger and bigger because the speed of transactions keeps increasing. We have the telegraph, then the telephone, and then now we have the internet, and then you have obviously mobile internet. All of that keeps increasing, but there was no physical settlement that could keep up with that, and so that role was entirely filled by middlemen, basically centralized maintainers of the ledger. And what Bitcoin is that ever since 2009, we finally have fast settlement for the first time, and so that actually closes a speed gap that had been building up for a century and a half. And so almost every friction in finance was solved by another layer of centralization, right? So it's like if I want to send money to you, we use a third party, a bank. If banks want to send money to each other, they plug into like a bigger bank. If central banks around the world want to settle value with each other, they plug into whatever the biggest central bank is. And so it's just more and more layers of centralization kind of solving all of the inefficiencies of finance. But what Bitcoin does is it finally says, here's an efficient way to move value around that actually decentralizes it. And it's not just another tech on the transaction layer, it's a tech on the settlement layer. And so you can actually de-abstract and de-complexify a lot of what's happening in finance and money. And so even though it's a technology that actually can simplify a lot of things in finance. And so I view it as a massive trend change, and it's something, it's not a decade story, it's a generational story. It's a multi-decade change from how a multi-$100 trillion system works to how it's going to work in the future.
Over the next 15 years, how do you see Bitcoin evolving, one, as a store of value, and two, as a medium of exchange and as a peer-to-peer network?
I think that's going to look different in different environments, right? Because not everybody has the same monetary problems, right? So if you're in a developed country, there's a good chance you don't really have a payment problem. You don't generally find there's a lot of frictions when you're trying to buy coffee.
Lyn calls attention to that we're liable to see better upsides and higher lows of expansion contrasted with past decades. Despite the fact expansion has directed to around 3%, it stays tacky at this level due to things like accelerating again energy prices. To put this in perspective, the state of the global economy has shown that overseeing expansion is a complex challenge influenced not simply by public strategies, yet additionally by worldwide emergencies and changes in energy markets. For occurrence late information shows that energy costs are climbing indeed again because of international strains and supply imperatives, highlighting Lyn's study of a stubborn inflation climate. As we dissect these patterns, keep in mind the larger picture as well, effects on your ability to spend and choices about investments. Let's back to the Lyn Alden interview.
And even in many developing countries, if you're sending money in the country, it's often fairly efficient. Where payments start to get interesting is when you look at, say, Africa. They have something like 40 currencies in Africa. Imagine all those frictions, right? And then there's something like 30 currencies in Latin America. Every one of those conversion points is a friction point. And then, of course, if you're in any jurisdiction where there's arbitrary bank freezes or mass surveillance and control of the money, there's kind of this natural incentive to get away from that. So I think that in some environments, payments come earlier because people have an acute payment problem. Whereas if you're in the United States, if you're in the UK, if you're in Europe, you probably experience payment frictions less often on a daily basis. So for people in those types of countries, I think the store of value aspect comes first. People view it as an investment. They view it as something that is competing with, say, equities or real estate in terms of long-term protection against currency debasement, and it's quite good at that role. So I think that it's just different problems for different people, and even like some around the margins, some of the non-monetary use cases. Bitcoin is basically it's the most decentralized, immutable database humanity's ever figured out how to build. And so some people want to use that to timestamp something in it, for example. And it might not be a monetary use case, but they're also, they have a problem, and then they're using it to solve a problem. So I think that the adoption patterns will vary. I think in general, store of value tends to precede payments, especially in wealthier environments. But those payment issues show up first. I mean, one of the first use cases of Bitcoin was WikiLeaks was the platform from financial services and turned to Bitcoin for donations. So the payments aspect has been there from the beginning. But for most people in developed countries, they solve their store of value problem, and then maybe later they look into their payments problem. So that's a very long-term story. I mean, Bitcoin's over $1 trillion market cap. Those combined, I mean, the global wealth, depending on what measurement you look at, is something like, 500 trillion or 1,000 trillion, which is a quadrillion, right? So Bitcoin is like a fraction of 1%. I think over the long arc of time, it starts eating into savings accounts, it starts eating into sovereign bonds, it starts eating into things that we monetize for lack of good money. And this during the phase where that's happening, that can be disruptive. Like if you're invested in things that are getting disrupted by Bitcoin, that's obviously not going to feel good. Nation states are going to push back on it in various ways. They already have, in various capacities for the past 15 years. It's going to be this ongoing story. But in the long run, not monetizing housing is good, because if you monetize houses, meaning if you're wealthy and you don't know what you do with your money, so you just buy extra houses, that's not good for people that actually want those houses as a utility good. They want them to be as cheap as possible. So there are costs of monetizing utility assets, and Bitcoin can, over the long arc of time, address that. But I think that's even when Bitcoin is 5 times bigger than now, it's still a drop in the bucket compared to global assets. So I think that, again, this is not it's not a 1 year or 3 year, 5 year story. It's not even a 10-year story. That's a multi-decade story. And so with technologies, people often overestimate the speed and then underestimate the final magnitude. And I think that's gonna be true for Bitcoin. I think people routinely overestimate the speed with which it will fundamentally change the system, quote unquote, the system. But I think that they underestimate the magnitude of what it can do over, say, a 30-year period or more. Like the transformational change that can happen with how we do payments, what things we decide to store our value in, the success rate of our investments. People, when they don't know what else to do, they invest everywhere. They just kind of invest into all sorts of malinvestments. And actually having kind of a default really good savings units increases the thoughtfulness with which you decide to actually put that money into.
As Lyn Alden makes sense of there's presently permanently more money moving through the economy, which has complicated things to enable wage earners to keep up expansion, affecting everything from the juxtaposition of housing costs and grocery costs is ironic, is that while ostensible wages have expanded, the genuine purchasing power has not maintained in line with the rapid inflation in essential products and services. To add importance of depth to this discussion, to take a gander at how national banks' activities such as raising rates of interest affecting various parts of the economy. Interest rates are rising, intended to lessen inflation by borrowing and spending money to increase depth. It is critical to this discussion to look at how actions taken by central banks like the effects of rising interest rates are higher in various economic sectors. The purpose of interest rates is to reduce inflation through spending reductions and borrowing. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.